Hello, everyone. This is Brian Bortz. I'm one of the partners here at Kane Waters and Associates, and I'm also the chairman of the investment committee. And this is your investment update for the month of June. The month of June was pretty volatile. A lot of down on the equity side. Domestic equities, as measured by the S&P 500, were down 8.3% for the month. Global stocks were down 8.6 for the month. Bonds actually did protect a little bit, but they were still down. Domestic bonds, as measured by the Barclays aggregate, was down 1.6%, and global bonds were down 3.2%. So all in all, a pretty hectic, chaotic, volatile month that ended much lower. In fact, it was probably the worst performing equity month that we've had, calendar month, in recent history. So I am joined today by Brad Sanders, as always, from Tectonic Advisors. And Brad, let's just start out by kind of throwing to you and just say, hey, what the heck's going on with the market, and why are we still so volatile, and what's happening right now?
Yeah, I think we finally have kind of reached that inflection point where we saw it in late June. The 10-year Treasury yield got up into the 3.2% range again. And then very quickly, the last few days of the month, dove below 3%. It's this morning, where this is July 5th. It's at about 2.88%. That's a humongous move for a Treasury bond and yield terms very quickly. And I think what the market is doing is basically throwing in the towel and kind of just accepting the reality that we're going to have a recession. That's just kind of our baseline view now, is that it's unavoidable. I mean, if you look at the textbook definition of what a recession is, we're kind of already there. There's all this debate on, is it's going to be 24 months from now or 36 months from now? I think it's going to happen a lot sooner. We may already be in one and not know it yet. There's a lag to all this economic data. So, you'll be in a recession and find out you're in one in economic terms later. But I just think that's what the market's doing. And what it's doing is kind of what it's been doing on the Fed side. We've on these videos, we've talked extensively about how the market's been basically pricing in the Fed what they say before they actually do it. And I think that's what the market's done now, is that they're pricing in a recession before we get to one. So it's interesting, I think everybody's natural predilection is to duck and run when you hear the R word. But we're kind of already priced in there. I mean, the market in GDP terms, not percentage terms, but in GDP terms, the market's dropped 46% of annual GDP. Annual GDP for the United States is like $22 trillion. So you're talking about a $9 to $10 trillion decline already this year. That's big. We saw like a 70 to 80% decline in 08. So we've already blown through a lot of the declines we've had since then, and we're kind of approaching those kind of levels in terms of dollar loss in the market, not percentage loss. Stocks aren't down 46%. That's just the dollar loss. And I think that's what the market's saying, is we're pricing it in. I think the market's set up, perfectly to kind of bifurcate here, where we may already be in a recession, stuff's really beaten up, and maybe kind of like 2000, where parts of the market start behaving a little bit better. And broadly speaking, the market's not healthy overall. But I just kind of think that's where we are. It's being confirmed. Commodities have been everybody's, stare at that and talk about inflation and look at these commodity prices. Commodities the last week have gotten taken out back and shot. And if you don't believe me, go look up the chart of copper. I don't think I would have ever in my career seen a chart of copper like the one we have right now. And that's just an indication of global economic weakness. That's all that is. Copper goes into basically everything. Okay. When you have moves like that, that's what that's telling you.
So yeah, Brad, I appreciate your comments. I would also say, for our listeners right now, one thing that I just gleaned from Brad's comments was he talked about 2000, 2008, now, he talked about all these different time periods over the last couple of decades that we've already gone through and that we've seen and learned from. And the most compelling thing that I can tell our listeners today is that when you're thinking about what are my advisors doing, so what is Kane Waters doing about this? The best piece of advice I could tell you, and the best thing to help you be able to sleep at night, is to say that we actually looked on the investment committee at every allocation that we had, and we looked at whether or not there was any variance or need for change right now. And the fact of the matter is, currently, we're not making any substantive changes to our allocations, which means that we've already planned for this, and we felt like something like this could happen, and we've already anticipated what could be going on. So we're very comfortable with where we're positioned right now. And like Brad mentioned, there will be opportunities in the coming months and maybe even coming year that will allow us to take advantage of this pre-pricing in of a recession, to hopefully position your portfolios even better than they are today. So I think the good news is that we feel very good about how we're currently positioned for our clients. And Brad, did you want to add anything to that?
Yeah, I think you hit it, and I think now our attention is turning to how do we position ourselves to benefit from this down the line. We always try to think in terms of 5-year cycles when we deal with the Kane Waters Investment Committee, and when I talk daily with Brian and Hunter, and that's where we're spending our time now. We've long wanted to own something like emerging markets and just haven't had found an entry point we were comfortable with, and we were already approaching one. Emerging markets were as cheap to the United States as they've been in a long time, forever, pretty much. And now they're getting even cheaper. So there's just going to be opportunity for like kind of generational type buying opportunities. That's what we want to focus on, and not try to micromanage some decline in our heads. We want to be thinking, okay, how do we position our portfolio to fully maximize our returns on the way back, and where can we really add value here for our clients? And I think that's kind of where we're going to be focusing. Probably what you're going to start hearing a lot from us, over the next 6 months.
Yeah, I agree. And first, I want to thank everyone listening today for the opportunity to serve you guys, and look forward to visiting with you again next month when we are ready to do our July update. So thank you very much.